Greetings, fellow investors. I'm Steve Symington, Lead Advisor at 7 Investing, where it's our mission to empower you to invest in your future. We do that by providing monthly stock recommendations to our premium members and educational content that's freely available to anyone. Today, you're in for a special treat. I'm joined by Chris Mayer, author of 100 Beggars, Stocks That Return 100 to 1 and How to Find Them, and currently a portfolio manager and the co-founder of Woodlock House. Chris, welcome to the show.
Steve, thank you. Good to be on with you.
So can you tell us, I guess, a little bit more about what keeps you busy these days?
Yeah, so I started a fund called Woodlock House, and we launched in January 2019. It was backed by a family office that I worked with before. The Bonner family owns Agora and a variety of publishing enterprises, and that they were my publishers when I wrote my newsletter before that for 15 years. So ever since that, I've been running Woodlock House, since basically a concentrated portfolio, aimed to own about 10 to 12 stocks that we can own for the long haul. And yeah, that's what I've been doing.
Okay, so 10 to 12 stocks. Some people, I mean, that is definitely concentrated.
Yes.
And kind of the genesis, I guess, of this podcast episode and having you on was your book, 100 Beggars. You guys can find this online pretty easily. And I've been seeing people share it for so long. I finally bought it and actually ended up reading it in 2 days and about 150 pages of it on the second day. And, my wife looks.
Oh yeah. That's what I caught you on Twitter where you were camping. You had it there. That's how I met you, so to speak.
Yes. And it was a fantastic book. It's funny because my wife looked over and she's like, well, that looks kind of dry, and she doesn't like to read stuff. And I'm like, well, no, this is one of the better books I've read in the last 5 years. And it's incredibly quotable. And early on, you cite some wisdom from Thomas Phelps when he says, in order to make money in stocks, you need to have the vision to see them, the courage to buy them, and the patience to hold them, noting that patience is the rarest of the three. Now, how does that wisdom play into your current portfolio management style?
Yes. Well, I mean, when Phelps, when he wrote that, it was in a chapter where an early chapter where he's telling you stories and little anecdotes of people who have had stocks return 100 to 1. And he's trying to impress upon you, one, that it's possible, because the people he cites they're not great investors. They're just ordinary people. They're people he's worked with. And he was editor of the Wall Street Journal for a time. And the secret to their success, you might say, is that they bought these stocks and they left them alone. And so that, I think the big takeaway from Phelps and that quote is that, first off, it's possible. So, you aim big, and if you don't get there, don't worry about it. I mean, a lot of people get very literal with me, and they'll be, they'll want to try to get that 100 to 1, over the next 5 years. They want to be able to envision how a stock gets there, but that's not really the key. The key is to figure out kind of the mechanics of what creates the 100 bagger, which is what I spend my time in the book doing, and what Phelps does in his book. And then once you find those traits, really to let the power of compounding do its work and leave those things alone. So that what you cited there is sort of the crux, or it's at the heart of what I'm trying to do at Woodlock House as well, which is just to find, a dozen or so compounders that I could leave alone. I hate using that term compounders because it's so abused, but find these stocks that have these sorts of qualities that Phelps and I talk about in our books, and that I can sit on and hold.
Yeah, and that's I think the key is just holding, and that is so hard.
Yeah.
For everybody to do. I think that's the biggest thing is, we get a lot of questions like, hey, should I sell this stock? It fell 3%. And I'm like, oh goodness, let's.
A lot of education involved there.
Yeah. Pump the brakes. And so I actually love that the book focuses on what you call an everyman's approach to huge profits in stocks. Can you elaborate on that? The everyman's approach?
Well, I think one of the differentiating factors in this is that while it is hard, that one key factor that you have pointed to, patience, which is, I agree, that is really the hardest part of it. it's also the most critical ingredient, probably above all, is that that's something that everybody can do.
Yeah.
Even though it's hard. And in my mind, when we first read that, I was thinking, like, I remember when I was younger learning about investing, and you read those books, like the Market Wizards books, that Jack Schwager wrote about, these guys doing these incredible things and making just huge sums of money, but they're often doing things like trading futures or doing, things that ordinary people just can't do.
Yeah.
And I think that's the part of the beauty of the 100 Baggers approach, is that it mixes things in there that everyday people can do. They can identify, good businesses that should be around over the next decade and sit on them.
Yeah, and that's there was one quote after you kind of introduced the everyman's approach, and you said there's lots of good ways to make money in the markets. This is a quote: just as there are different ways to make a really good pizza, nonetheless, there's something to be said for a really good pizza that almost anyone can make with the right ingredients. And that kind of hits the nail on the head for me.
That's right.
Because so many people will watch movies like The Big Short and be like, wow, there's so much money, and they sort of dream that way. It's like, but you can do that. And, and we're talking about 100 bagger, stocks that return 100 to 1, for perspective, this is a stock that you could put, say $10,000 into and turn it into $1 million.
Yeah.
And it's something that takes, for anyone listening, a long time sometimes, anywhere from 10 to 30 years, when you're looking at the measurements that you're using in that book. But with that kind of patience, that's when you start to see truly ridiculous things start to happen in your portfolio. Now, you also mention a concept of the twin engines as it pertains to finding 100 beggars. So if I understand it right, you need growth in both the size of the business and the multiple the market puts on the stock. Can you elaborate on that thought? Twin engines?
So when you really get these stocks that really take off, often they had this double combination. So let's just say, for simplicity's sake, you could, if you buy a stock at 20 times earnings, and the earnings over the next 5 years double, and it keeps its multiple of 20 times, you've doubled your money over 5 years, which is a perfectly fine outcome we'd all be happy with. But if you can find something that goes from 20 to 40, and then you've had a doubling in earnings, but then you've also got a double in the multiple. Now your $2 earnings is worth 80. So you've made 4 times your money, right? Instead of double. So I mean, the math gets exponentially large if you can find something like that. And of course, that's really difficult part. And I wouldn't pay too much attention necessarily on trying, because what people will do is then they'll be afraid to pay up for a good business. And then I have lots of anecdotes where people did things like, pass on Starbucks at 40 times earnings, and then it's up 100x since they said no. And we've all had those stories. So you don't want to get, you don't want to lose the forest from the trees here. But the truth is that when you get both those things working for you, you can really make some phenomenal returns.
Yeah. And I think Austin actually had a good little thread after Square released earnings. And it's one of those things, it's like so many stocks just look expensive, but then their multiples get even wilder, and eventually, it might settle, but the market rewards them. And that's kind of that ideal situation, having that twin engine kind of working for you. Growth.
And sometimes when that happens is the business gets better.
Yeah.
So if you find businesses where the margins are getting better, that tends to be something then where the multiple will also go up.
Yeah.
And so if you can kind of peek around corners or find companies that their margins are actually kind of increasing as they get bigger because of some network effects or because of economies of scale, that's where you're more likely to find that re-rating.
Or some new product, Amazon pops right into my head, when they AWS, and they're right after their core retail stuff.
Or Apple, has created several different, new products they didn't have at all, starting with the iPod, so it's just,
So who would have been able to, predict that? I don't know, but that's kind of part of the challenge is I like finding businesses with optionality that way. So on a different vein, we've spoken at length at Seven Investing on the topic of capital allocation, and Simon and I actually dedicated a recent podcast episode to the different ways companies can approach it. And we sort of listed 6 different ways. I think you mentioned 5 different ways, but one of them is kind of a nothing way. But you can do nothing or stockpile cash. You can invest in growth. You can make acquisitions. You can repurchase shares. You can pay down debt, or you can pay a dividend. But I was kind of surprised, actually. I turned the page and I was like, oh, an entire chapter dedicated to the topic of stock buybacks on accelerating returns. Can you offer kind of some thoughts on the way you think about buybacks, when they're arguably the best way to handle money and when maybe they should be avoided?
Right. Well, that's I felt I had to include that because there were these instances of stocks that where the underlying business didn't really grow all that much, but they still were fantastic. So obviously, one example everybody thinks of is Teledyne with Henry Singleton, who bought that great gobs of stock, and stock did very well. The one I focus on in the book is one example I use is AutoZone, which the underlying business didn't grow much at all, but they retired 75% of their stock, and so the returns were very good on that stock. So I felt I had to include that to kind of account for those. I know buybacks are a little bit controversial, even among super intelligent capital allocators. I mean, I think, for example, Mark Leonard at Constellation Software, who his opinion of buybacks is it's almost like insider information, and you're taking advantage of shareholders who don't know as much as you do. And I think he even uses the term, he's turning shareholders into prey. So that's one of the more extreme ones. But I mean, I think just rationally, the way to think about a buyback is that it is another avenue for capital. And there are times when your business repurchasing or basically buying your own business may be the best use of that capital. And when you do that over time, reducing that per share, reducing that denominator, I mean, that's going to accelerate the returns in like free cash flow per share and all those other metrics that we pay attention to. So it is, if you find companies that do it well, it's a nice thing to have.
Yeah, and it's for anyone unfamiliar with buybacks, if you're listening, it's it's just essentially, they're buying these shares, they're retiring them, and they're making remaining shares worth more per share on a per share basis for the remaining shareholders. So again, you find that the people who are winning are the people who are just hanging on.
Yeah.
And, enjoying this, they're taking those shares kind of off the market.
And as long as the company continues to grow and increase in value over time, that works out.
Yeah. And I think one big example that surprised me, even when Simon and I were talking about on our capital allocation podcast, was Starbucks. The amount of shares they bought back is it's staggering. We'll have to refer back to those numbers. And, we even saw Berkshire Hathaway start repurchasing its own shares recently. So, but when it happens at scale, like with something at AutoZone, when you talk about reducing their share count by 75%, is what you said. I mean, that's stunning. You don't think, kind of sneaks up on you after a few years. You're like, wait, how much have they dedicated to this? And
I mean, there are some companies out there Charlie Munger uses the term cannibals. They're just, consistently grind away at their shares. And even if there's only a few percentage points a year, over a decade, suddenly you've retired a third or 40% of your shares. It's really,
and you couple that with even modest growth, in the actual business, and it can be an interesting way to compound and accelerate your returns. So,
conversely, if it's done very poorly, it can destroy capital enormously.
Well, yeah, it's like, what if your stock is expensive? You should do it.
I think Coca-Cola was infamous for doing buyback when their stock was like 50 times earnings, and they were getting basically 2% earnings yield on that money. It didn't work out. And likewise, if companies do things where they borrow a lot of money to buy back stock, those generally don't work out. You want them to come from internally generated cash.
That's a fantastic point. There are times when it's not, and that's, I think more companies get a lot of flack for actually repurchasing shares, because they view it as a vote of confidence in the company, but it's not always maybe a false vote of confidence when they should be doing so. So there's better use for that capital. Yeah. What about the role, moving on to a different topic here, of qualitative versus quantitative investing on finding potential 100 baggers. Now, you kind of mentioned, like, with qualitative investing, you shouldn't really care so much like what the Federal Reserve is doing, which I think, even though you wrote this book a few years ago, it's particularly prescient.
Yeah.
When you look at today's, environment, it's a wild market we're living in right now. Qualitative versus quantitative. What do you think on that note?
Yeah. Well, when I think of qualitative too, I think of all those things obviously that aren't in numbers. So there would be things like, do you trust the people? Do you trust the people running the company? What's the culture like? This is something I've spent more time thinking about this year and into last year. Sometimes there is a culture that comes through, and you can see it in annual letters. You can see it in transcripts when management talks. Mm-hmm. There's a focus on running the business and doing the right thing for customers, adding value for people, and creating win-wins. I know that's a cliche, but being shareholder friendly, not, so versus management teams that are wildly overpaid, where the alignment is clearly not there, where they're being rewarded for doing something like growing sales, which doesn't necessarily increase shareholder value. Yeah. Or where their product is sort of questionable, whether they're really taking advantage of their customers or not. Or, there are other ways to think about culture, but I think those qualitative factors are important. And some of the other things you were talking about with the Fed, I kind of think of those as kind of more macro questions. Mm-hmm. And, sometimes they can be important as well. I mean, we're going through this pandemic, and you couldn't just completely ignore that, because it did fundamentally change how businesses are run. And some businesses are going to be incredibly stressed by this. And it's not something that's just going to last for 1 month or a few quarters or a year and be done. It might be something that is around for a long time. So you have to adjust. That's, I would say, like, most of the stuff that you read about the economy and forecasts and what GDP did and what the latest unemployment number is, all that stuff you could probably safely ignore. Yeah. And you look at these past 100 baggers, you can see how, those kinds of concerns, they didn't really matter. They just plow through all these things over a period of decade. It doesn't matter. And even, you could just think in your own experience, try to think about what was important a year ago. What were you thinking of a year ago? This week? What was the moment, thing of the day that seemed so important back then? Whatever economic data point it is. And it's not even important now, so that's why I think it's much more, you get a bigger bang for your buck. You get, if you pay more attention to just what's going on with your particular business.
Yeah. I mean, I look back at the beginning of this year, and I remember the Australia wildfires felt like a big deal. Like,
Funny you mentioned that example, because I was talking to an Australian friend of mine, and he said that. He goes, if you could roll back, the Australian wildfires were like a couple countries on fire. That was the big news. Yeah. And it's like, 6 months later, nobody's talking about that. It's
it's hard to believe it's only been that. But yeah, I think it helps put it into perspective. What businesses have been able to just plow through, in the process, and does it matter over the long term that for businesses that are really built to last? Yeah. You kind of mentioned, I think, charts. Do you buy a stock? Don't buy a stock because you don't like the chart. Will it matter? Next month? Right. So that's kind of hard. I mean, if you have a 50% swing or something that drastically changes the multiple at which you're buying a stock, then maybe. But I'm not. I don't focus any time on technical patterns and those sorts of things. But not to say there's validity.
Right. And that's a very important point, because with the 100 baggers, I mean, they all suffered drawdowns of varying degrees. And I spend quite a bit of time in the book going through a number of examples where, you have these big, massive, severe drawdowns, but you don't even have to go that far. You can just think of, good stocks that have 15%, 20% drawdowns. Yeah. It's so what? But at the time, it seems like, it can seem like it's a crisis moment. What do I do? The stock is down, 20% from where it was last quarter. Yeah. And over a long period of time, those don't really matter. And we look at some of the patterns of some of those winners. The other thing, I think, is not only drawdowns, but it just can be the sheer boredom of it. I mean, I know I had some examples of stocks that just went nowhere for years. My favorite example was Berkshire Hathaway, which there was a 7-year stretch where it went nowhere. And yet that was the best performing stock in the whole study. But think about it. I mean, you and I know, I'm sure our listeners know, they're involved in this thing, looking at stocks every day. To hold on to something for 7 years and go nowhere is an eternity.
Yeah.
It's a long time.
Yeah. Well, and even now, I have people kind of looking back at Berkshire over the last decade and comparing it to the S&P 500 and being like, oh, it's underperformed so badly. And I'm not particularly concerned with stuff like that, and anymore, to be honest. It's like when I have a stock that drops 20, 30, 40%, I barely even blink,
Right.
because for me, it's a matter of trusting my homework, trusting the thesis, and not just blindly trusting. If it drops like that, there might be a reason, but go back, make sure it's still valid.
Yeah.
Consider adding to that position, at a certain point, adding to a winner.
Right.
But yeah, it's stressful, I think. And that's maybe the hardest part is weathering those kinds of periods.
And I think, Phelps had one interesting thing I like, and he does in his book, because he has these presentations where he'll take a company like, I think it was Pfizer he used, and he has a 20-year table where he shows you earnings per share, sales per share, dividends per share. And I think it's like the return on equity. And the point is that this is a company that's very stable every year. ROE is something like 16 or 15 or 17%, just bop, 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 bop.
Mm-hmm.
And earnings are going up. Yeah, every once in a while there's a pause where it doesn't, but then it goes back up. But his point is, if you just looked at this table, and this was like 100 bagger over those 20 years.
Yeah.
If you just looked at that table, would there be any reason for you to sell the stock? Of course, the answer is no. But if you look at the stock chart, what happened during that whole time, it was an up and down ride. And there was lots of moments where investors were probably scared of whatever, thing happened at the moment. So, I mean, you're exactly right. You focus on that business and you go back and check, you try to make sure it's, your original thesis is still invalid, and the business that is still what you thought it was.
Yeah.
But, if there's no business reason to sell, then you're almost always better off just leaving it alone.
Yeah. I saw a tweet the other day. Somebody said, if Netflix has returned like, I don't know, 10,000% over the last, 12 years, the average investor would have sold it 10 times.
Yeah. Oh, that's definitely true. I mean, yeah, I agree with that. I mean, you see things go up 10. I mean, you have a stock goes up 10x,
Mm-hmm. How many times would you have sold it along the way? And that's I think the key. And you mentioned boredom. Well, I'd like to ask you more about that later.
Yeah.
But that also kind of raises a question over why people chase returns. Can you offer kind of some perspective on why people tend to chase returns? Like what you mean?
Yeah. Well, I mean, some of it too is that because they're, being hit all the time with the prices. So
mm-hmm.
I know I told the story somewhere. There was a friend of mine who invested in art one time, and he bought a painting, and he just because he liked it, and he put it on his living room wall, and he left it there. And then 20 years goes by, and he decides he's downsizing, he's going to sell. So he's got this painting that he really bought and he liked, and he decided to go to Sotheby's and see what it was worth. And it turns out it's worth like some huge multiple of what he paid. Say he paid $15,000 whatever, now it's worth like $800,000, something crazy like that. And first thing he was telling me the story, I remember he said, well, if somebody was there every day giving me the price for what that painting was worth, there was no way he would have just left it there for all that time, because there would certainly been a time where he'd been like, wow, it's worth tenfold what I paid, I'm gonna get rid of it. Or times where then it was up tenfold and then maybe it came back down, he's like, well, I gotta get rid of it now. Or part of it is just because you're always hit with that, and if you didn't see it, you might not be so willing to chase returns and have to go after something else.
Yeah.
So I think that's a big part of it. And one of the things, one of the ideas I like is that coffee can idea. I know we talked a little bit about it beforehand. I don't know if we talk about it now, but that's an interesting idea too. And so the idea of the coffee can, it comes from a guy named Robert Kirby, who was a money manager. And he wrote an article, I think it was in 1984, It's called the coffee can portfolio. And it's an interesting story how it came about, because he was managing money for a client, and unbeknownst to him, this client's husband, I think he was managing the wife's money. The husband would kind of copy the picks because he saw what was going on her account. So he'd buy a little for his account when he saw new buys come in. But there was one difference, is that he never sold anything. So Kirby's over there being the good active manager, and he's adding things here and trimming things here. Occasionally he sells something, puts something in. The husband's over here just buying and just leaving things alone. And then at some point the husband dies, and that account rolls over to the wife and is back in Kirby's charge. And that's when he sees it and it hits him. He looks at it and he sees there are several stocks that are up like multiples, what he originally recommended. And there's one stock that's worth more than the entire account, the wife's account. And that really hit him that, all this transactions we do, all this stuff, he would have been better off just leaving them alone. So that's where he came up with the idea of this coffee can, where comes from the old West, where you put all your valuables in a coffee can and you just sort of hide it and leave it away, hide it somewhere, look at it. And so the equivalent would be, you come up with a portfolio of whatever it is, 10 stocks, and you kind of create your own coffee can where you don't look at those. You kind of carve off some money and you're just going to let those ride and see what happens. That's one way to sort of conquer the temptations, to do things if you consciously
stop buying everything. And
right.
I've talked about that several times with the guys. It's like, we've written updates and everything. It's just to say, had we not sold anything we ever bought, there'd be some losers in there.
Absolutely.
I'd see stuff I bought a decade ago that's worth less today, but by and large, I'd be much better off had I never sold anything. And, you look at, some of these stocks that I was buying, I found some old brokerage statements from like 15 years ago. And I'm like, oh my goodness,
yeah,
it's really, I wish I still owned that. And, it's hard to tell, find the money trail and see what I did with it, since then. But, with so little effort, buying it, putting it away, coming back and just checking after a decade or something and see what happened. And,
right.
Kind of like that coffee can idea.
Yeah, I do too. I mean, and that's, you mentioned something else that made me think about when people ask, well, what's your biggest investment mistake? People are usually inclined to think about some stock they bought that cratered and, they lost a bunch of money on. But the biggest mistakes are the ones, like you say, the things that you sold.
Mm-hmm.
Those are the worst things that you sold. And then you look up, 10 years later, and you're like, holy cow, if I had just sat on that.
Yeah.
I remember one of the first stocks I ever bought way back. And then this would be like in the 90s. It was Intuit.
Oh.
And I think, wow, if I had just left that thing alone, I mean, it's a huge winner. So,
yeah.
I mean, those are your biggest mistakes.
Yeah. I wrote a little update for 7 Investing a couple of weeks ago. And I think I was talking about, it was only 5 years ago. I just sold a small basket of stocks. I was like, I needed some cash for a down payment on my house. And I'm like, well, let's turn to my portfolio and sell a few of my stocks. And I kind of went evenly across the board. And one of them was NVIDIA 5 years ago. And I sold,
oh, wow.
There's a few hundred shares for, I think, about $6,000 or so. And now I look and those few hundred shares be worth something like $120,000. And
right.
I'm like, oh my gosh. And, spoiler, my down payment on this house was not $120,000.
Right.
But that's just 5 years, and
yeah.
Rewind farther and the stories get more sobering and so
yeah.
And really, you find a lot of investors taking this sort of manic active trading approach to stocks. And you shocked a lot of that up to boredom. You've mentioned it before, but what other ways, have you found are best to kind of deal with the challenge of being bored when buying and holding stocks for long periods of time?
Yeah. I mean, that besides the things that I've mentioned, so the coffee can is one kind of interesting idea, focusing on the business is another kind of interesting idea. Just, if you have some metrics that you look at and maybe you update, every year, that can be a way. I've been thinking about this. This is the one that I've been thinking about only recently because I've been more active on social media, Twitter and things. And, there's always these people who put out how great they're doing, either their accounts or some stocks. And, that the pull of that is also, I think, can be definitely negative. I mean, if you're constantly comparing yourself to where other people are, and you're
Yeah.
constantly comparing your stocks to other stocks, I mean, that's going to drive you crazy. So you somehow have to stop that. Don't constantly compare yourself, benchmark yourself, every quarter and year against, other portfolios, other stocks that you see, because you're bound to give up on what you own.
Yeah.
And Phelps talks about this too. He writes about how almost everything that you read and hear from Wall Street or investment community is a kind of a call to action. Always someone's trying to get you to buy something, and you can't buy everything. And so somehow you have to filter that out, and that's another aspect of it.
Yeah, I think you mentioned in that book too, like, that's why I travel a lot. Like, just to keep yourself occupied.
I haven't been able to do that. Haven't been able to do that this year, which has been a killer. But
what a difference a few years makes. But
definitely. But I love to travel. I would go all over the place, and that would get you away from your computer screen, get you away from obsessing over your tickers and news. So even now, I mean, there are times where I just don't log into my account. I just don't look. And sometimes I see how long I can go before, I got to at least look. And to be honest, it hasn't been more than just several days before I'll have to go back and just take a look. And
I'm sure more than a few people listening could say, they've hopped onto their account, several times already today, and it's early.
Yeah, that's right.
And that's hard,
it's super hard. I mean, because you're curious, you want to see what's going on. You get that little dopamine hit when your stocks are going up, Yeah.
And then the crash when they're falling.
Then you feel bad when things are going down. Damn it, never should have bought that thing. What was I thinking? Beat yourself up. I mean,
yeah. And, so I'd like to maybe talk more about the number of stocks. That's the other thing is people say, like, how many possible 100-baggers could there be? And you list, I think, in the appendix or the index of your book, 365,
right.
Which incidentally was the same number of stocks I think that Phelps had in his index when he wrote the original book, which is really interesting. That's a lot of 100-baggers, and some of them might be really, really difficult to predict. But, in hindsight, you look back and you say, well, this, should have been somewhat evident to people.
And some of them were much more than 100-baggers. They were up thousands. So it's like, you could have bought some of those 100-baggers. You could have bought any time for a stretch of like 5 or 10 years and made 100 times your money.
Yeah. So you've got a decade to find this thing. But actually, that's one of the questions we've received fairly consistently since we launched from people is, at Seven Investing, is how in the world can you possibly think there are 7 attractive stocks to buy in any given month?
Mm-hmm.
But I love that you cited some stats from Graham in your book that there are over 5,000 publicly traded stocks at the time. There's a lot, over 10,000 now.
Oh, easily, yeah.
Yeah, well, on the, even just the U.S. markets.
Oh, right. And if you start international markets, you're really getting up there.
Yes. So, and that's, really, the individual investor, Graham says, should be able to find at least 1% of the total list. And at his time, that would have been 30 or more that offer attractive buying opportunities. Now it'd be 50, 60 or more.
Right.
And that's, I think, a very important point, is there are a lot of good businesses out there. And you wrote something to the effect of if you can't find, anything compelling, you're not looking hard enough.
That's right.
Do you, I'm assuming you still agree with that sentiment.
Yeah. I mean, I do. And sometimes I react to the people who want to just always say, well, stocks are overvalued, and then they stop.
Yeah.
It's kind of like saying, nobody makes a good hamburger anymore. It's like nobody, nobody, that is not a single person in the country can make it, so that's why I feel like you're saying stocks are overvalued. It's like, all of them, really? Every single, you're telling me there's thousands of stocks. You're telling me you can't find, 50 that might look interesting. I mean, then you're just not looking, because there's always interesting opportunities. And that's one of the things that came out. Well, that's one of the things Phelps talks about in his book, is it's just every year's recurring batch of, dozens of 100-baggers that you could have bought. And even just doing the study, then myself and updating, it was the same thing was true from the period of time I did it, updating it from 62 to 2014.
Yeah.
Every year there's lots. So, and again, my study too is only limited to the US market. And I also put, market cap and liquidity restrictions around it. So if you were to even loosen that up, you throw Canada in there, you throw some European markets in there. I mean, it's even bigger. So I would agree. There's lots of opportunities.
So I have to ask to that end, are there any kind of potential 100 baggers that have caught your eye at this stage that you're sort of kicking around, kicking the tires on here?
Yeah. I mean, I have some stocks that I really like, and I think they're not particularly big, and they have these attributes, and their returns on capital are, 20% or above. And I think they're companies that ought to be able to compound for 10 years or more. So, you do the math, I would have to say that there may be one in there, but it seems absurd to say it because some of them are really in kind of boring industries. They're, whether it's like pizza delivery or just doing ordinary things that you wouldn't associate necessarily with something that's going to go up 100-fold. So that's like why I always emphasize in the book that, not necessarily to sit there and look around for stocks and say that, I'm looking for something that goes up 100 to 1 because it seems so incredible.
Yeah.
And yet if you looked at, a lot of stocks that did go up 100 times or more, they often were humble businesses. McDonald's, I mean, who would have, if I had gone to you and had a hamburger chain with 100 something stores or 200 stores or whatever they had when they were public, it would have been a stretch to say, well, it's going to be 100x. But if you just focused on, the individual unit economics of a McDonald's franchise, and you could see how the return on capital they were getting every time they added it. And so I prefer to think of that 100 bagger question as a math problem, really. Try to focus on those companies that earn that high return on capital, can reinvest and earn it again, and where you think they've got the runway. And then the math and the time will do that work for you. Yeah.
It'll eventually compound.
And even if you don't hit the 100x, as I always say, so what if you get 50x? People, you're going to be delighted. 10x.
I only found a 50 bagger.
That's so disappointing. This book,
no one ever.
Said no one ever. I mean, I wish I had come across this much earlier because, for a good long part of my career, I was just kind of more a value investor. Mm-hmm. I'd buy things that are undervalued, sell them when they got close to being fully valued or overvalued. And I think this is a much better way to be, to find some quality assets that you can just sit on and own.
Yeah.
So.
Well, and you're still not that old either. So
I still have time, I hope. Yeah.
Yeah. I think I'm like, okay, I'm only 37 years old at this point.
Yeah. You got a lot of time. You can do it still. You can do it.
I got to get 3-4.
Got to get one. I mean,
yeah. So.
Chuck Ockray, who I talk about in the book, Chuck Ockray is a great investor. Mm-hmm. He's got 2, so it can be done.
Yeah, well, and someone asked me, I didn't respond. I kind of waited to respond because I figured we'd talk about this in the Twitter thread where we were talking back and forth when I was camping and reading your book.
Yeah.
They said, how many 100 baggers have you found, Steve?
Oh, everybody always brings that up. Yeah,
and I'm like, I said, well, I'm still young. And, I look at the time and I haven't found I hope some of the stocks that I bought early and I'm still hanging on to will turn into a 100 bagger. But
right,
like you said, it only takes.
Yeah. Well, that's also, people will ask, well, how many have you had? And it's kind of a little unfair because one thing, I wrote the book in 2015. Yeah. So I've only, I haven't really been thinking in that way for very long. Mm-hmm. And even after I wrote it, I still, I thought of that as a portion of something I would do in a portfolio. Whereas now I'm just kind of, it keeps growing and other things I keep dropping. This is becoming more and more the focus of what I want. But, so what, if the principles are the principles, whether I have had one or not, it doesn't matter. Whether you have one or not, it doesn't really matter. And getting closer to the goal is the idea.
Yeah, exactly. It's like, okay, I've got a few 10 baggers under my belt, 15 bagger, and they're getting there.
Yeah, I've had a 10 bagger as well. And I also think, what Phelps says is also important because he says, if if you don't think that way to start with, you'll never get it. You know, there is something to be said for putting out that huge goal, saying, yeah, you know, 100 times my money.
Yeah. And, you know, where it really happens is toward the end of that journey, you know.
Yeah, that's really important, because when you look at it, you know, every time, yeah, I mean, it's all back end loaded. I forget the math of it now in my book, but you know, the difference between being up 50x and 100x.
Yeah. No, and you talk about the, you know, you hear people talk about the amount of wealth that, say, Warren Buffett, for example, has built in the later years of his life. It's something like more than 90% of his wealth has happened in the last like 15 years. Mm-hmm. And, you know, he's been at this for 5-6 decades, you know, and he's been doing this for, so it takes a while, but it
takes a while, and it's back and loaded. I mean, I think of the story, I'm sure you've heard about the lily pads, you know, they double every day. And then on the 30th day, they fill up the whole pond. And then so on the 29th day, how much of the pond is full? You know, it's like half. So you think about it's all, you know, a lot of it comes in the back end.
Yeah. And that's when it kind of becomes stunning. So, before we wrap up, I do want to ask about, and we mentioned this briefly earlier, you talk about opportunities and pitfalls of investing abroad.
Yeah.
Are there any international markets today that you think are particularly compelling?
That's a good question. You know, I don't usually think about it in those terms, so I don't necessarily think, you know, this is a market I want to be involved in, so I'm going to go over there.
You mentioned earlier you focus really specifically on the U.S. today, but
I do have quite a bit in Europe also.
Okay.
So, yeah, actually, the beginning of the year, the fund was more tilted to Europe. Mm-hmm. So I think, you know, I've found some very interesting companies in the UK, maybe a little not as well known. I mean, if you look at the overall market, like the FTSE is kind of like their Dow, you say, you know, that hasn't gone anywhere in like 20 years. It's pretty unbelievable. Now it's had ups and downs and all that, but it's basically where it was 20 years ago. Yeah. And a lot of these European markets can sometimes be like that. I mean, I have a company listed in France, one in Italy. So for me, it just kind of expands the menu of things to look at. Maybe gives you a chance to get something that's not so, you know, well covered or appreciated.
Sure.
And as long as you can, you know, it checks the other hurdle. So are the disclosures good, or, you know, can you trust the people involved? And a lot of companies in Europe are family owned, and which can be a positive and a negative. I mean, normally I think of family ownership as being a positive over here. And there's a number of companies I own where there's a family that owns a decent percentage of the stock, but, you know, that family has proven to be shareholder friendly over time. And I think that's not necessarily always the case in Europe. It's more of you got to be more careful. But I think there are some good capital allocators over there that maybe are not as famous or as well appreciated. I have found some interesting things in other markets to do.
That's food for thought. That's great, actually. And it's one of those things where I think people sort of, you know, think, well, this is played out, and, you know, there's so many interesting markets out there to look at. But it can also get, you know, a little overwhelming. I feel like sometimes I have my hands full here in the US, but
right.
At the same time, you know, Austin and Matt Cochran and Simon Erickson one of our upcoming podcasts is going to focus on the Indian stock market. Mm-hmm. They have some really interesting conversations they've had recently to that end. But it's a big world.
All those markets have 100 baggers too. You know, that's what I would like. I'd like to see. I'd like to see other people from other countries kind of do similar studies to what I've done, but do it on their markets. I mean, I'd love to see one for like the UK, or see, you know, French, you know, actually the French market too has had a number of super successful companies. So yeah, Australia, I'd be curious, but yeah, they're all, you know, hunting grounds.
There's a call to action for all you investment writers, for anyone who's running a newsletter who might want to do a similar study.
There you go.
That'd be great. So if you're listening, do it. Let us know you're doing it, because we'd love to keep an eye on you. So
yeah.
And speaking of which, I think that's a good place to wrap up our conversation. Chris, where can people keep an eye on you if they're interested in following you? Where can they find you?
Yeah, well, it's easy to follow me on Twitter. It's at Chris W. Mayer, Mayer. And I also blog occasionally at Woodlock House blog. You can find by searching for Woodlock House blog. It'll come right up, or just to my Twitter account. I always post it there as well. So yeah, you can definitely keep track of me that way.
Good. And you can also find his book pretty easily on Amazon, One of the 100 Baggers that we've talked about.
That's right.
It's awesome. Thank you so much for taking the time.
Hey, thank you for having me on. It's a fun conversation for sure.
It's good. I really appreciate it. So yeah, let's wrap it up there. Thanks everyone for listening again. I'm Steve Symington, lead advisor with 7 Investing, here with Chris Mayer, and we're here to empower you to invest in your future. Have a fantastic day, everyone.